Most people misunderstand Bitcoin. They think of it as free money, a way to get rich, and when they see the price rising, they assume it's safe to borrow against it and buy more. Here's the problem. Bitcoin's volatility isn't just numbers on a chart. It can wipe out your gains and even your capital if you're not careful. Borrowing against Bitcoin can be riskier than most investors realize. The principles for managing the risk and how to rethink your strategy so you can stay in control while still taking advantage of opportunities. Borrowing against Bitcoin seems logical, but Bitcoin has historically delivered massive returns, and platforms now make it easier to get loans using Bitcoin as collateral. You might think, if Bitcoin keeps going up, I can borrow against it, buy more, and make even more money. That's the perfect scenario, and it's the narrative most beginners hear in crypto communities. Low interest rates, easy access, and the chance to amplify gains creates a sense of opportunity. But here's the thing you always have to remember. Bitcoin is extremely volatile. Its price can swing 20 to 30% or even higher in just a matter of weeks. When that happens, borrowed funds become a double-edged sword. Instead of amplifying gains, leverage amplifies losses, and you could lose your Bitcoin entirely if the market turns against you. So you always have to do your own due diligence before investing. Measure twice, cut once. Volatility is a measure of how much an asset price moves over time. If Bitcoin, for example, moves much larger than traditional assets like stocks or bonds, the mistake most investors make is confusing volatility with risk. Volatility itself isn't bad. It's just movement. Risk is the potential for permanent loss. And borrowing against a volatile asset without a plan converts price swings into real permanent losses. So here's the real key takeaway. Volatility is expected. Borrowing amplifies risk. The combination of the two is dangerous if you're not prepared. So always, take your time before investing and look at the big picture and weigh all the risk. If you're going to borrow against Bitcoin or any volatile asset, you need to already have a plan in place. Here are 4 core principles that we teach. Only use capital you can afford to lose. Size your loan conservatively. Have a clear repayment plan, and respect your time horizon. Let's talk about the first one real quick. Only use capital you can afford to lose. Think of borrowed funds as separate from your core holdings. Never put your essential capital at risk. That's rule number 1. Always protect your principal. If a market happens to see a downturn and forces liquidation, you should still have enough to stay invested long term for the big picture. Investing is positive sum. So just being invested in the market, you're going to see gains over time. Second, size your loan conservatively. Margin calls are not abstract. They can happen fast. A small drop in Bitcoin's price can wipe out borrowed positions if your collateral is too thin. Always leave a buffer. Treat volatility as something you have that you can use for you. You want to use volatility, for gains. You always have to I always like to invest, dollar cost average, just because you never can truly predict if something's going to continue to go down. Something could happen overnight and change everything. So just dollar cost average every single week is a great long-term strategy. Next, third, have a clear repayment plan. Borrowing only works if you can repay regardless of short-term market moves. Don't rely solely on Bitcoin appreciating to cover debt. Factor in income, stable assets, or alternative sources for repayment. Fourth, respect your time horizon. Short-term price swings are unpredictable. Only borrow if you can manage the position long enough to ride out volatility without panic selling. Think of years, not months. You're always looking for the long term. If borrowing feels too risky, there's smarter ways to gain exposure to liquidity without putting your wealth at unnecessary risk. We just discussed dollar cost averaging. Instead of borrowing to buy more Bitcoin, set up a consistent schedule to buy over time. Dollar cost averaging reduces timing risk and keeps you disciplined. Another key thing is diversification is key. Don't over-concentrate in Bitcoin. Even if you believe there's a long-term upside, spreading risk across multiple assets protects you from liquidation. Buying stocks with moats, a real estate property, all excellent ideas. Let's go over a few steps that you can take before borrowing against Bitcoin. First, assess your exposure. Second, stress test your position. Third, plan repayment strategy. Fourth, limit leverage. Fifth, track volatility. First, you always want to calculate how much Bitcoin you can truly borrow against without endangering your core holdings. Model potential losses if Bitcoin drops 20 to 50%. Ask yourself, can I handle this without panic selling? You know exactly how much you'll repay the loan without relying on Bitcoin's price going up. Start small and always leave a buffer. Treat leverage like a tool. It should be used correctly. Use charts or alerts to monitor price swings. Stay disciplined and don't make emotional decisions during short-term moves. And here's a bonus tip. Volatility itself is not the enemy. Poor borrowing decisions, lack of planning, and emotional reactions are. The key is always to plan correctly. So here's a few key takeaways. Bitcoin is volatile. Borrowing amplifies risk, especially when used without a clear plan. Only use capital you can afford to use. Size loans conservatively and have a repayment strategy. The real risk is behavior, not volatility. Discipline protects your wealth. Appreciate everyone watching the video this week. Please hit the like and subscribe for more. We'll have another video next week. If you have any comments on Bitcoin or Ethereum, please feel free to leave them in the comments below. And we'll be more than happy to answer any questions.